Hi friends, my name is krishnaakumalla. Welcome back to my YouTube channel. We have already discussed about historical cost methods previously. We discussed about FIFO, LIFO, simple average method, weighted average method, and we understood how to value the closing inventory. Because they are all historical cost methods, they have the historic cost, historic price available for the inventory. Based on that historic price, different methods are being, applied and arrived closing inventory. In today's video, what we are going to discuss is, we are going to discuss on non-historical cost methods. What are those non-historical cost methods? Who are those people use these non-historical cost methods, and how those methods can be applied? That is what we are going to learn in this today's video. Are you ready? Without wasting much time, let us get into the presentation. Okay? Okay, guys. We are going to learn non-historical cost methods today. How many non-historical methods are there? There are two non-historical methods. One is adjusted selling price method. Other one is standard cost method. These are the two methods we can learn as a part of non-historical cost methods today. Non-historical cost methods do not consider the historical cost incurred to acquire the goods. What does it mean? In historical cost method, what we did, be it FIFO, LIFO, weighted average, or simple average, what we took there, we took historical price of the inventory purchased. For example, January 1st, if I purchased one lot at so and so rate, that rate has been taken into account for the valuation purpose. Because what is January 1st rate? January 1st is historic cost. So if that material is part of my inventory, I used to take that as a part of my valuation purpose. Correct? So in historic method, we used to take the historic price of those inventories and used to calculate the inventory value by end of the month. But in non-historic method, we cannot use historic prices. Why you cannot use historic prices? That is an important point. Because these non-historic methods, cost methods, are applicable for retail people. Retail people will manage multiple products. Go to supermarket. How many products will be there? Huge number of products. Is it practically possible for us to assess or identify what should be the historic cost of each and every price? Practically not possible. That is the reason why these non-historical cost methods are applicable for those kind of business units. So now we understand, we are going to learn what are those two methods, right? Adjusted selling price method, and other one is standard cost method. What do you mean by adjusted cost selling price method? This method is also called retail inventory method. Adjusted selling method, adjusted selling price method is also called as retail inventory method. Why retail inventory method? The name itself says retail. Retail inventory method. So retail organization, retail business organizations, what they do, they maintain multiple products. It is not practical for us to go and identify the historic cost of each product because they keep changing the products. So it is used widely in retail business or in business where the inventory comprises of items, the individual costs of which are not readily ascertainable. Very simple. It is not readily ascertainable for those products because they keep changing. The use of this method is appropriate for measuring inventories of large number of rapidly changing items. Rapidly changing items. Because if you go to super bazaar or supermarket, they keep on changing their items. There will be a rapid change you observe there. And it is not practically possible for you to go back and identify the historical cost of those items. In that situation, how do you assess the closing inventory? Very simple. What they do is they will identify the closing inventory. They will take the total stock of closing inventory and they will assess the saleable value. Let us say the selling value is 1 lakh. I'm just taking a ballpark figure. Selling value of the closing inventory. Selling value of the closing inventory. I'm not talking about the cost. I'm talking about the selling value of the closing inventory is 1 lakh. Okay. They know their gross margin. Let us say their gross margin is 25%. They will calculate 25% on this 1 lakh and remove this gross margin. And they will arrive the cost. Why they need to arrive the cost? Because inventory valuation has to be done. Cost or net realizable value, whichever is less, whichever is lower. So they can't take 1 lakh saleable value as an inventory. They need to arrive the cost. How do they arrive the cost? They will take the selling value of the closing inventory, and they know their gross margins. They will remove the gross margin out of this, and they will arrive the cost, and whichever is less, they will take into account. Obviously, the cost will be less. Are you getting my point? So, the use of this method is appropriate for measuring inventories of large number of rapidly changing items that have similar margins. And all these items, whatever items I'm referring to, they will have more or less the same gross margin percentages. If you go to supermarket, you ask supermarket fellow, he will say, yeah, I get around 25 to 30% margin or 15 to 20% margin. That is how he will talk. That means what? He cannot specify gross margin of each item there. On an average, he will say, I will get around 15 to 20% of gross margin. Correct? So they know the gross margin. So this gross margin will be almost similar for all the items, whatever they manage. It's not that exactly it is going to match. The cost of inventory is determined by reducing from the sales value of the inventory an appropriate percentage of gross margin. Simple. They know their gross margin. As I said, if they know that their gross margin is 25%, they will take the sellable value of the inventory and reduce this gross margin, and they will get the cost. And the cost will be considered for valuation purpose. As simple as that. The percentage used takes into consideration inventory which has been marked below its original selling price. The percentage used takes into consideration inventory which has been marked below its original selling price. That is important. An average percentage of each retail department is often used. As I said previously, what did I say? One product might give maybe 30%, another product might give 25%. Some other product might give 28%. But they will take average gross margin of all the products. You getting my point? An average percentage of each retail department is often used. The calculation of the estimated gross margin of profit may be made for individual items or group of items or by departments as may be appropriate to the circumstances. For example, one group of items, they know what is the percentage of gross margin they get. And if that is not similar with other lot of groups, probably they will divide that items into group wise, and okay, this group gross margin is this, and this group this gross margin is this group of products, this could be the gross margin. Let us take all the gross margins and average it. If that is not possible, when they know that average gross margin is going to be 25%, let us take 25% on an average. What is their gross margin into account as a department as a whole? So there is no hard and fast rule that this is how you need to arrive here. Whichever is appropriate to the current circumstances, you take that percentage into account and calculate the percentage on inventory saleable value and reduce it, and you will get the cost. So that is how the adjusted selling price method has to be calculated. So I'm going to explain this with an illustration so that you will get more clarity on this. Okay, let me move on to the illustration now. See here, Mr. X, Y, and Z are in retail business. Following informations are obtained from their records for the year ended 31st March 2020. What is that record they have taken? Goods received from the suppliers is 15,75,500. Goods received from the suppliers is 15,75,500. Subject to trade discount and taxes. Trade discount 3% and sales tax 11%. So trade discount is also there and sales tax is also given in this. Now, packaging and transportation charges 87,500. So for bringing that products, goods. Sales during the year they have given 22,45,500. So sales value we know. Sales price of closing inventory 2,35,000. This is very important. That is what I was saying. 1 lakh I took in my previous example as selling price of the closing inventories. That has been given in the problem. Find out the historical cost of inventories using adjusted selling price method. We need to identify the cost. How do we identify the cost? What we need to do is simple calculation, guys. Goods received from suppliers is how much? 15,75,500. In that, trade discount 3%. You calculate 3% on this. How much it will come? 47,265 is the trade discount. Let me calculate. 15,75,500 into 3%. 47,265. 47,265 is the trade discount that has to be reduced from this figure, because trade discount we cannot take into account. We should not record into the books of accounts. So the net value of trade discount is 15,28,235. On that, we need to add sales tax 11% as given in the problem. So let us add 11% of sales tax. 11% if you calculate, it will come to 1,68,106. Once we add the sales tax, the value will become 16,96,341. So this is the total value of the goods received. On top of it, what business did? They spent 87,500 as packaging charges. So we need to add packing charges also to that. So the packaging and transportation together. So when we add these two, your value is becoming 17,83,841 rupees. This is the total value of the goods they received. This is the total value of the goods they received. Why this is required? This is required for calculating the gross margin. Why gross margin is required? Once you know the gross margin, you can calculate on sales price and arrive what should be the cost. Simple. So now, you know what is the sales price they have given, selling quantity value, 22,45,500 is the sales value they have given. So we have taken the sales value. Closing inventory sales value they have given. Selling price. So 2,35,000 if you reduce from, if you have to add back to arrive the total saleable value. So you will get 24,80,500 is the total inventory, including whatever goods sold and whatever goods are in inventory put together. You get 24,80,500 because we are arriving the gross margin now, right? So you need to add back this. So it will come to 24,80,500. On from this figure, what you need to do, you need to reduce the 17,83,841 of the cost of goods received. Cost of goods received we are reducing 17,83,841. Then you will get 6,96,659 as your closing inventory. Now, you can calculate what is the gross margin of, what is the gross percentage. Gross percentage will come to 28.09%. How did you get this, 28%? That is something which you need to understand. 6,96,659 divided by 24,80,500 is equal to 28.09%. If you do this calculation, you will get this gross margin. Getting my point? I just now did it in calculator. So you got 28.09%. Once you know this gross margin, selling price of the closing inventory is how much they have given in the problem, 2,35,000. Take the 2,35,000 and calculate this margin. So how do we calculate this percentage? 28.09% you just need to calculate on 2,35,000. 2,35,000 into 28.09% is equal to 66,012. This is the gross margin. Once you reduce this gross margin, you will get what should be your cost of inventory. This is your cost of inventory. Simple. This is how you need to calculate the cost of inventory by applying adjusted adjusted price method, adjusted inventory price method. Okay. So I hope you are clear on this topic. If you have any questions, please feel free to comment on my video. I will get back to you with my answers. Okay. Thank you so much.